Hi, I'm Deng Hui, Chief Investment Officer at UOB Private Bank. Welcome to CIO Compass, UOB Private Bank's quarterly investment viewpoints. Last month, the key development centered on the collapse of Silicon Valley Bank and the subsequent failure of Credit Suisse, leading to fears of a banking crisis. In our view, these incidents are idiosyncratic and unlikely to morph to a 2008-style financial crisis. Banks overall are better capitalized and policymakers are better equipped to deal with such crises. Financial markets corrected briefly, but have mostly recovered. The Fed's tightening monetary policy has contributed to decline in bank deposits due to migration to money market funds to seek for higher yields. This will result in banks taking a more cautious stance in lending, which will further tighten financial conditions. The upshot, however, is that the Fed may end its tightening campaign earlier than expected. Another good news is that inflation has started to decline. This will give the Fed rooms to pause and eventually ease policy. If the Fed were to go on an extended rate pause, the economy could gradually slip towards a deeper slowdown. The yield curve Fed chair power most commonly referenced to is now the most inverted in 20 years. Inversion of such magnitude would suggest that the Fed will have to pivot at some point in time. Right now, the key tension in markets is between fading Fed risks and slowing growth. We are optimistic the global growth slowdown will be relatively mild. Asian growth is expected to be more resilient, driven by China's reopening, while Europe is experiencing a cyclical upturn. Overall, we think a mild slowdown against the backdrop of slowing inflation and incrementally less hawkish Fed may be supportive of risk assets in general. What are the investment implications? Number one, tighter monetary policy will eventually bite. We believe a deeper slowdown is a matter of when, not if. We advocate a defensive stance in US equities, focus more on high-quality bonds, especially in shorter to intermediate duration, as the slowdown broadens. A core allocation to bonds will act as a defensive anchor should the economy falters. Number two, seek risky assets with divergent cyclical profile. First, the tech and growth sectors have undergone material earnings downgrade ahead of the broader market. Higher cost of capital also imposed financial discipline, as evidenced by announced layoffs and cost-cutting by the major tech firms. Second, invest outside of the US. A case in point would be China, where we see signs of an early cycle recovery. European economies are also recovering and valuations are less demanding compared with the US. Number three, increase allocation to alternative assets. As tight policy will inevitably induce some uncertainties, suitable investors should allocate a portion of their assets to alternative sources of returns, such as private markets and hedge funds. Compared with public markets, private markets have higher potential for managers' alpha, lower correlations with stocks and bonds, and hence provide enhanced portfolio resilience. Gold is likely to be well supported as real yields decline, while oil prices are expected to stay firm on OPEC's proactive output discipline. China's sustained demand recovery on its COVID policy reversal also acts as a tailwind. To sum up, we believe that tighter monetary conditions could eventually lead to pockets of stress and a slowdown towards the end of the year. However, we still see opportunities for investors. We advocate a combination of defensive and quality growth stocks in the US, investment-grade bonds, and regions outside of the US. Suitable investors should also consider an allocation to alternatives to enhance portfolio resilience. That's all for today. Do look forward to our next episode of CIO Compass For more insights, please speak to your senior client advisor.